All right, so we said that assets are increased with a debit, okay? And we also said that liabilities are increased with a credit. So again, we still have to get our minds wrapped around the fact that things are different than the way they are in the banking industry. If you don't know anything about the banking industry, that's actually a blessing in disguise. We have some examples here, but again, it says, you know, if we recall back to what we discussed before, we said that assets represent future benefits and liabilities represent current obligations or future sacrifices. So it says here liabilities are debts owed to outsiders, creditors, and we have some examples here. Accounts payable, notes payable, wages payable, accrued expenses was on one of those balance sheets that we looked at. And then notice this fourth one here, it says unearned revenues. The reason that unearned revenues are a liability is it represents cash received from customers before services are delivered. So if you really think about it, think about if you ever wanted to go to a concert and you bought your tickets in advance, and let's just say that the tickets were $100 a piece and you bought two of them, so you spent $200. Well, that company, that promotion company that's making this concert happen, they have $200, right? They have $200 from you and probably from a lot of other people. But here's the thing: they have an obligation to you. They're going to make a future sacrifice in the form of going to all of the expense and effort to perform that concert. Okay, so that's why unearned revenues are liabilities, and liabilities have a normal credit balance. Stockholders' equity is the third portion of the balance sheet. And it says here, stockholders' equity is the stockholders' rights to the assets of the business, or as we said before, net assets. Stockholders' equity is represented by the balance of common stock. We said that these are owner contributions and retained earnings accounts. And these will have credit balances. Why? Well, let's think about it. You start a company, you invest money into the business account. The business account gets cash. They get cash, which is a debit, which is actually abbreviated in accounting as DR. And they issue common stock, so the common stock is a credit. Now, if we were to think about retained earnings, we say that when we get cash, it is a debit, right? And that the other side of that transaction is revenue, which is a credit. And assuming that our revenues are greater than expenses, we're going to have this thing called net income. Okay? And net income flows to retained earnings. So I don't know if it will help you or not. Okay, I don't know if this will help you or not. But retained earnings has a credit balance because it is a reflection of revenue. Okay, is a reflection of revenue by way of net income. And then finally, dividends accounts represent distributions of earnings to stockholders. Now, I told you that we won't find dividends on any kind of income statement or balance sheet, but I will tell you that dividends have a normal debit balance, and we're going to get into the why of that here in a little bit. Okay, so stockholders' equity essentially made up of common stock and retained earnings. Moving over to the income statement accounts, by explaining some of those asset accounts, we got into this a little bit already. It says the debit and credit rules for income statement accounts are based on their relationship with stockholders' equity. Okay, and we just said that, didn't we? We said that retained earnings was a reflection of revenue. The rules of debit and credit for revenue expense accounts are as follows. So revenue accounts a debit for decreases and a credit for increases. So again, I'll say it again. Let's say we make a sale on account. We make a credit sale. We've earned that revenue. So in that situation, this is an A here. Accounts receivable goes up. Oh boy, goes up with a debit. Okay. Revenue would go up with a credit because those two would match. Expense accounts are increased with a debit and a credit for decreases. Now you will rarely see an expense account decreased. But let's think about this. What do we pay our expenses with? Cash. So if cash is an asset. So at least in theory, cash is going down and assets go down with a credit. So therefore, expense accounts go up with a debit. All right, and we'll get to some examples here shortly. So as we get into this idea of the income statement, it says revenues are increases in assets and stockholders' equity as a result of selling services or products to customers. We have examples here. Sales revenue, which is very common. We might have repair revenue. Certain businesses might have commissions as an example, and we can even have rent revenue. We also had an example in one of our exercises from last chapter where we had some interest revenue. Okay, but I want you to understand that as these revenues, these earned revenues go up, we do that with a credit. Okay, and we're going to get into some examples. So if you're confused right now, just understand that what we're doing is we're simply laying the groundwork. Expenses result from using up assets or consuming services in the process of generating revenues, and that's kind of what we talked about. Think about wages. You work somewhere, that business has wage expense, which is going to be related to generating revenues. Let's say that you're a cashier. There's going to be wage expenses for that. But that cashier totaled up sales that in the process of generating revenue. So we have some other examples: rent expense, utilities, supplies expense, miscellaneous expense. Sometimes we'll have little small advertising expenses and so forth that we consider to be miscellaneous. Doesn't occur often enough to get their own account named after them, so we just kind of lump those into miscellaneous. And then finally, dividends. It says the debit and credit rules for recording dividends are based on the effect dividends have on stockholders' equity or retained earnings. The rules of debit and credit for dividends accounts are as follows. As dividends go up, we use a debit for increases and a credit for decreases. So notice what it says here. It says cash dividends reduce cash and increase dividends paid. So let's think about this now. We said earlier that dividends do not appear on any financial statements, but rather they're embedded in retained earnings. We said that retained earnings has a normal credit balance, okay? And that when we pay out dividends, that is a reduction to retained earnings because those earnings are no longer being retained. They're being paid out to owners. So if retained earnings has a normal credit balance, when we pay dividends, the only way we can reduce that credit balance is to do so with a debit. All right. Before we get into some examples, I want to bring up this concept of the accounting cycle. This diagram on our screen is a 9-step cycle. I prefer a 10-step cycle. A 10-step cycle would begin with identifying business transactions. And so now we're going to get into this first part here of actually recording journal entries. Whoops, went a little bit too far there. Okay. So in doing so, we have to introduce this idea of what's called the double entry accounting system. And this is what all businesses use. I've alluded to this already. The system is based on the accounting equation that requires every business transaction to be recorded in at least 2 accounts, and total debits recorded for each transaction must equal the total number of credits. So what I want you to understand is when we say that debits must equal credits, we're not saying for every debit there must be a credit. What we're saying is if we have total debits of, say, $1,000, our credits must also equal $1,000. We may only have 1 debit and 3 credits, but the dollar amount has to match. We have a little picture here that says happiness is when debits equal credits. Well, for a beginning accounting student, that may be true. But there's a lot of assumptions made in this statement. And we're going to get into how we can make some mistakes a little bit later in this chapter, and how we can't necessarily say that just because debits equal credits that everything is hunky-dory and wonderful. All right. So when we record these business transactions, we do so with debits and with credits, and we use a process called journalizing. And using these rules of debit and credit, transactions are recorded in a business journal. Now, historically, this could have been a paper notebook of some type, and oftentimes it was. Modern times, this is generally done electronically through computer software. It says further, the process of recording a transaction is called journalizing, and the entry that we're making when we do this is simply called a journal entry. This is just a little bit of vocabulary for you. Nothing too difficult, hopefully. All right. Last thing I want to talk about is T accounts. And T accounts are what we use to determine the final balance of an account. We can have a T account for any type of account. And notice here we have whether it's an asset that has a normal debit balance or a liability which has a normal credit balance. Debits are always on the left side, credits are always on the right. Doesn't matter what kind of an account we have. So real quick, think about our example for cash. let's say that instead of this saying assets here, we wanted it to say cash. I'll do this as best I can. Make that a little bit better. And we have a $50 deposit, and then we write a check, or we use our debit card for $20. We would say that the final balance in our cash account is $30, and it is a debit balance. All right, before we go any further, I'm going to go ahead and end this video due to time, and then we'll pick up with another one now.